Hello everyone, welcome to the live video for the Gamma Optimizer Room. I know this video is completely out of the schedule, we are just basically doing, because I could not do it on Friday, So I know I'm going to have only just like two of you. But it's okay because the important thing is to have a recording for other people to see. Hello, Louis. I can see you. So if you can hear me, please type on the chat that you can hear me and that you can see the presentation. That will be fantastic. So just let me know that you guys can see me okay. I'll wait a little bit in case of there is some issues here, but it looks okay to me. Okay, I'll assume that audio is okay and video is okay. I'm not sure if anyone is watching right now, but I'm going to start the video anyway. So let's start. Let's see what we have in store for today. In terms of close positions, we have, because this is we have 6 trades now so far until yesterday, and only 2 wins and 4 losses for the constant pricing system. And it seems that we just hit an underperformance patch after a nice start for the system, and we are actually down 435 per contract. We are losing 435 per contract on those 6 trades, and well, that's okay. I guess it's still within the limits. If we have a couple of wins, it should be okay. Now we should go back to green pretty soon. It's interesting that we are seeing such an interesting market regime right now, and by that I mean that VIX is extremely elevated right now, but realized variance is not. No, so this is one of the cases where VIX is looking really forward, is covering the period of the presidential election, and I think it's affecting everything. I think it's affecting the neural nets. So, but I'll keep an eye and see. If VIX becomes an issue, I will try to remove it from the inputs because it's now one of the inputs. But if it becomes an issue, then I'll remove it from there. And we could just focus on like VIX1, could be a better parameter, not the VIX for the next day. But for now, this is what we have. It is the constant pricing system that can generate 4 types of trades. Now it can generate a long iron condor, a short iron condor, a long risk reversal, and a short risk reversal. And I know that some of you don't like the risk reversals at all, including me. I don't like the risk reversals much. So I am producing an equivalent non-directional version of the system, no? So it's basically replacing, not replacing, but having them all of the systems, like 4 systems in total. One that is full, another one that is non-directional, another full constant pricing, and another non-directional constant pricing. And I've been testing it, it's okay, and I think that I'll share it with you guys in the Variance Center later this week. So just keep an eye on it soon. Now, in terms of market regime, the GT level is at 5,711, which is very close to where we are right now. No, we are basically just a few points above the GT level, and I will say that we are neutral for all practical purposes. No, and and that means the gamma imbalances are very small. Basically, what that means is that hedging activity from option dealers should not be an issue right now. They should not be the dominant force in the market. In fact, I don't think they have to hedge at all around these levels. Around these levels, they just basically can sit and watch the market and don't worry about anything because gammas are really small to the upside and to the downside. So in this particular region, I will say that this is a region where organic trading will be the dominant force in the near term. So mostly any volatility that we see in the market, any swift moves up and down are not because dealers are hedging, it's just basically organic trading. And by organic trading, I mean anything. I mean retail traders, I mean high frequency traders, I mean algorithms, I mean big players rebalancing portfolios. No, those kind of players are the ones that are going to define market volatility and market direction in the near term. So in terms of at least of gamma, there is not much to comment there. So I think that's kind of the situation in terms of the gamma imbalance. In terms of volatility, volatility is so interesting. Look at this volatility across all time scales. The 20-day, 20 session, the 10 session, and the 5 session, which roughly corresponds to monthly, bi-weekly, and weekly. And all of them are basically the same. No, RB20 is 10.4, RB10 is 9.4, and RB5 is 10.9. So all of these values of realized volatility, which is measured from 4 p.m. today to from 4 p.m. tomorrow, no, it's from close to close. All of those values are pretty consistent, pretty stable, and it's really low, no? And that has been, this is the interesting thing, that's kind of how it has been for the last couple of weeks. Now it's extremely consistent, it's low, and it's weird for October, no? I mentioned here that it's still early, but I don't see any seasonal effects in October right now, and where we should see very elevated volatility, but we are not seeing it now. We are not seeing elevated volatility. But VIX, on the other hand, is extremely elevated. Look at how VIX is almost 22, which is double what realized variance is. And I think this is what I mentioned before. There is a disconnect between implied volatility and realized volatility. And this disconnect has been happening for a while right now. I think you guys lost. I lost you guys. Sorry about that. I don't know if I was on the part of what I was talking about VIX. So probably some kind of internet failure. I guess electricity just uh, briefly flicker here where I am. So uh, yeah. So yes, I lost you guys. So I think I was talking about VIX, or I forgot where I was when I lost you guys. I was commenting how the disconnect between VIX and in realized variance. I guess this is the where I was. So I'm going to go over it just in case. So I was talking about VIX being extremely elevated around 22 and disconnected from realized variance. It's completely disconnected. It makes no sense that it's so elevated. But well, at the end, it makes sense because it's covering the period of the presidential election. But in general, the story of late September and early October has been VIX always running substantially higher, but extremely higher than realized variance, and that means dealers want to cover their behinds because they are afraid of something. Well, in the case of the election, we know that they are afraid of the election. So VIX is extremely overpriced because it's covering the November 6th, no, whatever it is the election in the US. The 1 week VIX should be lower. Now, 1 week VIX should be lower if the expectations for volatility were lower, but it is not. It is almost 18%, which is also 8 points higher that what we have seen in the last week, no, or what we have seen in the last 2 weeks is almost double. So it's interesting that dealers are overpricing options at this juncture. I don't know what they are thinking. I don't know if this is related to some kind of economic data release, maybe CPI numbers, or maybe I don't know. I don't know what it is that is coming, but this is very elevated. And 1 week VIX that expires next Tuesday is almost 18. So at least in terms of volatility, there is a huge disconnect between very low realized volatility that we have seen and expectations of extremely elevated volatility, both in the near term, like 1 week ahead, and both like 1 month ahead. No? So that makes for an interesting trading regime. As a disclaimer, I usually around this time of the year, around September and October, I try to trade in a small size. I usually reduce my size of trading because of this, no? Because volatility starts to behave in weird ways, and whatever it is, the systems that we have tend to underperform around these months. The interesting part about the Ultra NP system is that it doesn't seem to be affected by that kind of seasonal pattern of the second half of the year. But still, this is what I will urge caution to you guys. Like, try not to trade in high sizes and elevated sizes. Try to reduce the size a little bit because things are looking extremely weird right now to me. At least to me, they look weird. So we'll see. Maybe dealers have, maybe they are correct. Maybe really a huge volatility event is on the works right now, or maybe realized variance is correct. Like nothing will happen for now, and options are just basically overpriced all the time. Okay, so we can see this here with the term structure. In the term structure, we can see the election bump is very visible, is really high. And you can also see flatness most of the time, maybe into next year, like something happens here. I don't know what is that. Maybe that's the inauguration. No idea what is that. So the term structure is in shape. It looks similar to last week, but in absolute values, it's trending higher and higher. And I mentioned this a few weeks ago that as we approach the elections, this bump will be massive. Right now, it's approaching 22, but it might approach like 35 at some point. Dealers will overprice elections, in particular if we continue with this neck-to-neck race between the two candidates. Now there is not a clear favorite, so it's a toss-up, and dealers are just pricing. The thing that I am surprised is that options are so expensive for next week. So this is today, Wednesday, Thursday, Friday, Monday, Tuesday is around here. I don't understand why it's so expensive. Near-term options are close to 18. That's the only thing that is surprising. And again, maybe some of you could pinpoint the reason for that. Maybe there is some kind of CPI is coming soon, or some Fed thing is coming soon, so everyone is kind of looking at that. But so that's what is happening now. The dominant narrative here will be presidential elections. No. Here I have a question. How do we profit from a doubling in volatility for the election bump? Is there a cheap way to do it? Yes, there is a cheap way to do it. You could profit from this very simple. You could have a calendar spread in the S&P 500. So let's figure out when the elections are. Elections are on, it's on the Tuesday of November. Where is November? It's probably November 5th where the elections are. I don't know, I'm not an expert on elections, but let's assume that it's in November 5th. The election is in November 5th. Then what we can do is you do a calendar for a week before. For instance, you do a calendar for the 29th of October. So you are selling an option for the 29th and you are buying an option for the November 5th. Or you can do it like the 22nd of October, no? And the calendar, the important thing is that the back option of the calendar is on the election day. And the short option is before the election day. So as time passes, you are going to collect the time decay of the front option. No, so the front option will be decaying in value because that's how it works. But because of the election volatility will increase higher and higher, the option on the back end will not change in value that much. It will not decay. So you're going to pocket, it's a simple way to pocket time decay because of the event. No, if you guys, I can model that for you in the room, but I guess that's a trick that I used to do long ago for earnings. No, you could do it also for earnings. You can do it for elections. Is if you know that there is a huge event, options that expire the day of the event or the day after the event, maybe options for Wednesday. Now that those will be the options that will be overpriced. No options for a Tuesday because the results will be announced the next day. So the important thing is to figure out where the extreme overpricing is, and those options will be the back of the calendar. Now remember, the calendar is short on a strike earlier and long the same strike later. No, so that's how it works. And we could do that, and we could model it. But yes, you collect some money. There are ways to collect money there, just based on that. Or you can do a strangle swap, which is basically two calendars. But I'd be happy to expand on this on the main room. Thank you for the question. That's actually a very good question, Louis. Thank you. So this is how the term structure looks like. And it's not looking good, but I mean, we could take advantage of both things. We could take advantage of as the elections get closer just by using the calendar or the strangle swap. And then we could take advantage of the post-election recovery, based on what is happening overnight. But that's something that we can talk as November arrives. So in terms of, sorry about that, in terms of realized variance has been really, really weird. Intraday realized variance, this is the one that is measured during the day, minute to minute. So it's very unstable. It has been unstable. We were below 10 for a while. Now we were up and then below, then up, below. So it seems that liquidity is being fickle right now. Liquidity providers are being really nervous for some reason, no? And in particular, given that the market is almost at all-time highs, it's kind of surprising that volatility has been so unstable. I was expecting volatility to be a little bit more on the flat side here, but it is what it is. No, there is certainly something cooking underneath the market, and I will say that that coupled with the elevated near-term volatility means something. I don't know exactly what it means because I'm not that plugged to the market right now. It could mean that liquidity providers are ready to fly in a heartbeat. It could mean that option dealers are just seeing some extra volatility in the near time, then liquidity providers are just ready to flee the market. No? But it is what it is. So right now we are below 10%. We are below the magical number, but it could change. No, it could change for a while. And remember, even though seasonality hasn't been on cue this year. No, we got the volatility event was supposed to happen in September when we got it in July, and so it has been kind of all over the place. But one thing that tends to happen is that October is extremely volatile, and right now we only have 8 days into October, just a few trading sessions. I think six trading sessions into October. So there could be still time for realized volatility to really shoot up from here, but we'll see. No, I don't believe in seasonal effects right now, in particular with elections coming. I guess everything is just completely messed up. But we'll see. October in general is a month where we tend to see very elevated volatility. Okay, in terms of variance risk premium, man, here we can see the overpricing of the options after being negative for a while. This was in July. The July event was a surprise to everyone. Now, variance risk premium is around the 100 area, like double, 100% more expensive than realized variance. And that shows that dealers are really overpricing options right now. They are really, really jacking up prices. And it doesn't really correspond to whatever is happening. Maybe this is the normal, no? Maybe this is the normal, although I don't see why. So this could be connected to the elections I mentioned before, or just it's just what the new normal. No, dealers don't know what is going on, so they prefer to overprice everything. So there could be a source of edge extracting BRP. I will say that anything post-election is a fool's errand. So this is connects with what I mentioned in the answer to Lou. It could be a way to extract variance risk premium by doing the calendar swaps, or by doing the calendar trades, or by doing the strangle swaps. So that's a way to extract variance risk premium. I don't think the market will be that volatile in the near term. And I think the elections will be the defining moments. Although, we are starting earnings again this week, so I don't know, what will be the dominant narrative in the market, if any earnings will be dominant, or the elections are the end to all. No, so. But if we do it near term, probably 1 week ahead, I think that there could be some variance risk premium extraction, always using the election back. No, using the options at the back for the elections as the long leg. So that's what it looks in terms of variance risk premium. Tremendous amount of overpricing so far. In terms of ambiguity really is not a factor. Ambiguity has been really low. It's meandering towards zero. I haven't this slide didn't change much since last week. Only the graph changed. As you can see that now there are no tons of ambiguity in the market. So we'll see. At some point it might reach 0.2, but for now that seems so distant. So ambiguity is not a factor at this time. No. But I keep always showing ambiguity in the slides because we never know. No, we never know when it can shoot up really high. So in terms of the trade plan, Ultra MP. Now Ultra MP is for those of you that read the manual, is just the core of everything that we do. Now it's a probabilistic distribution, and with that we are trading in like four different ways now. No. Right now, the dominant trade for me is the constant price system because I find it better suited for what we want because it's using the prices and while the disconnect between VIX and realized variance still keeps happening, it's better to use the constant price system. I think it's better. No, we'll see if it's true or not. But I think the constant price system is better because it offers us at least the trades that are decently priced, as opposed in the if you're looking at, for instance, if you look at the non-directional trade from yesterday, it was recommending short iron condor that was giving us less than $1. No, I don't want to short an iron condor and receive less than $1 premium. It's very low premium for a short iron condor. It's a lot of risk, and so you're risking more than $4. And I don't like those kind of trades. But in the constant price system, where the iron condors are always priced around 2. No? And as I mentioned before, there is a non-directional equivalent system which only produces long or short iron condors, and I know that a lot of members like that. They prefer the long short iron condor over the risk reversals, and I agree. For me, I sleep better when I have that kind of position because I know that the mask risk is defined. I know what it is, but with the risk reversals, the mass risk could be 5 or more. No, it's a huge risk. Although the reward is fantastic. And for those of you paying attention, for instance, the full system recommended a short risk reversal for yesterday, and you won. So you won a lot of money. So it's nice when you win, but when they lose, they really sting. So I have the non-directional equivalent, and I have been testing it privately for the last week, and I think I'll incorporate it in the variant center soon so you guys can see it. So that's kind of the trade plan. Now let's look at the variant center for a while because I'm using YouTube. I always have to remember how to switch. Okay. So this is the variance center. You can see realized variance is above 10, but I mean it's early, so probably it will close below 10 at some point. And volatility is kind of flat. This I don't like this kind of curve when liquidity seems to be drying up with the market moving up. No, so the market is basically rising a lot from yesterday, and yet realized variance seems to be going up. So I guess liquidity providers are not providing liquidity on the way up. That's kind of the way I read this. No, so I like, for instance, yesterday the market was falling, but the realized variance curve was decreasing as well. So that means that there was liquidity on the way down. Right now, there doesn't seem to be that much of liquidity. It's not that there is no liquidity, it's just that I was expecting to see less than this. And you can see that the gamma imbalance, well, now is starting to grow a little bit to the upside, 42 billion selling to the upside, which is decent. It's not huge, but it's decent. So maybe we are going to slow down massively soon. No, massive slowdown at some point pretty soon. But we are long gamma, and we are close to the GT level as well. And in terms of kurtosis, look at this is gigantic kurtosis. It's 8.87. Remember that kurtosis should be very close to 3.0. No, in a perfect Gaussian world, kurtosis should be to 0, close to 3, sorry. So now it's 9.65. What that means is that the returns are non-normal, and therefore there is some kind of a non-random action in the market. And clearly, it's probably this data point right here. Clearly, there is massive buying by some big guys. Like the S&P 500 is a huge basket. It's very hard to manipulate. I know you guys, you read about manipulation all the time, but we're talking about a basket that you need trillions of dollars to move. Like you really need serious amount of money to move. Seeing kurtosis at 9.52 means that one guy or a few of those one powerful guys are starting to move the market. Like someone came massively into the market to buy. No, and you can see it here. It happened around 10:41 a.m. for some. I don't know what happened at that time, but someone just came buying massively, and that's why kurtosis is high. So kurtosis is a great indicator to see the invisible hand of the market, not the quote invisible hand. So most of the time, the market is just random action, random retail traders buying and selling among themselves. But once in a blue moon, big players come into the market, and when they do, they chop here in the kurtosis. And remember, this kurtosis only shows, this kurtosis value only shows the kurtosis for the last hour. So in an hour from now, it might go back to 3. But for now, you can see that something happened, and it gives you some information. It gives you some information. Here in the historical realized variances, as you can see better, what I was talking about how unstable it has been in recent sessions, the realized variance after a period of relative calm, we got this period of, let's say, instability. Now, which is I don't understand what is going on. And then you can see VIX. Now you can see VIX that after reaching a low of 15, it started just going up and up and up and up. And this is normal, I guess. As the election gets closer, you'll see VIX trending higher and higher. As the elections get closer, they come into view. It trending higher, and that's it. I guess in the variance center we have ultra constant, which seems to be suggesting a long iron condor for tomorrow as well. Yesterday I was, when you see me talking about VIX1, you pay attention to this column. This column will show you what dealers are pricing for the next day. And yesterday, around this time of the day, for some reason, VIX1 was like 25, like 0.25. It was really elevated. It ended up being 16, but it was so elevated. I don't know what was going on there. Today is kind of normal. It probably will end the day lower than 15 if it continues like this. So tomorrow it doesn't seem anything bad. But yesterday in the morning was weird. It was really elevated, but now it's kind of coming back to normal. So I think that's all, folks. I really appreciate you guys joining the live video, this really sui generis live video in YouTube. And the reason I did it in YouTube is just because we have this system, we have the GoToMeeting system, and I know that during the week we have kind of allotted schedules to do the live videos, and mine is on Fridays, so I don't want to like mess up anyone else in the room. So that's why I did it here. So this is only for today. On Friday, we'll go back to the usual. But and anyway, I really appreciate you guys joining, and hopefully you got something out of out of the live video. And the recording will be there for all of you. No, that's the point, to have a recording. And as usually, you have questions, just let me know in the main room. I'll be more than happy to answer all the questions. And if you guys want me to expand on the strangle swap for the elections, I'm more than happy to do it as well. Okay. Okay, again, thank you very much. See you in the room, guys.